Let's talk the fundamentals with Pankaj Tibrewal, the Senior Vice President and Fund Manager Equity at Kotak Mutual Fund, joining us on the show. Pankaj, hi, very good morning. Thank you so much for making time and speaking with us. Let's begin by discussing the market itself. Are you getting a bit cautious, especially on the mid-cap and the small-cap front? Because a lot of these mutual funds have stopped taking money when it comes to the small-cap universe. There's scarcity of opportunity. Are you feeling that pressure as well?
Good morning. We have seen a very sharp run-up over the last 3 months, and especially in the broader markets. Yes, the recent run-up has made us a little bit cautious on the broader market space. And let me share with you a few data points, which are all pointing that in the near term, the mid and small caps looks a bit heated up. First, on a fundamental basis, if you look at, we always track something called earnings yield, which is nothing by PE. And on a trailing 12 months basis, if you look at, the earnings yield of large cap is 4.3%, mid cap is about 4.8%, and small cap is about 4.6%. On an average, they are much below their 10-year averages. And today, if you look at, there's hardly any gap between the earnings of large cap, mid cap, and small cap. So why to take extra risk in mid and small cap when at the same earnings yield we are getting large caps? So that's one point to be noted. The second important point is that if you look at from a overall market capitalization perspective, mid and small cap as a cohort is now 28% of the total market cap. And by total market cap, we mean NSE 500 universe. On an average, this number has been about 23-24%. In 2007-8, we saw this number moving to 27-28%. It is now back to the historical highs. And large cap as a percentage of total market cap has come down from 78-79% to 72%. So clearly, market has moved and re-rated a lot of mid and small caps, which can be seen as a percentage of total market cap. The third important indicator which we track is the sentiment indicator. It has helped us over cycles. And what it does is it does a Nifty 100 value participation, which means that during times of greed, everybody wants to own mid, small, micro, and nobody wants to own the top 100 stocks of India. On the fear side, everybody wants to hide themselves during crisis in large caps. So today, when we look at that number of Nifty 100 value participation, that number has come down to 48-49%, which means greed is there on the street. And generally, we have seen that whenever investors invest during this period in mid and small caps, the next 12 months return tends to be inferior. Anything above 65-70%, you have a margin of safety there. And investing during those times gives you higher returns. This is the third indicator. And fourth, when we look at the free float expansion over the last 15-18 months, on the other side, the AUM expansion, both by domestic and FI as represented by shareholding, I think there's a mismatch and there's a scarcity premium where too much of money is chasing very little free float stocks. So I think one needs to have a slightly careful approach at this moment. Everything is looking hunky-dory, but I think at some point of time, all our indicators on valuation, sentiment, as well as technical, are suggesting that near term there is a chance of a pull-off rather than this sustaining for a longer period of time.
Pankaj, so looking at the market construct right now, which sectors, according to you, are most undervalued and overvalued at this juncture?
So clearly, we have been talking about the capex recovery. That probably is showing signs of promise if you look at from a 2-3 year perspective. And across, which is import substitution, China plus our own domestic-led, capex recovery, investment recovery, I think is an important theme which we are playing across our portfolios. In the near term, there is a probability that they may see some kind of a cool-off because last 2 years have been very strong run-up for most of the names. But if you take a 2-3 year perspective, I think that looks to be decently placed. The second one, probably where we are seeing early signs of recovery, is pharma. And on valuation basis, also, the sector has gone through a 5-year underperformance, and valuations have corrected meaningfully out there. Our sense is that when we look at the March quarter results, this was the first quarter after many quarters that the US generic revenue for most of the companies were either flat or marginal increase. So the price erosion, which we have seen for last 2.5 years, seems to be coming under control, maybe in mid single digits, which high single digit or double digit, and that bodes well for US generic growth. Indian market, any which ways, continues to do well for most of the pharma companies. So pharma could be a decent play from a medium to long term, and valuations in our favor. The third is financials. Even after the high growth last year, we believe that a large part of corporate India growth this year also will be driven by banking and financial services. Our bias is there towards private sector banks and some select NBFCs. So that's the third sector which is looking okay. Fourth is autos, and there we are more positive on the auto ANGs, which are spread across either four-wheeler, commercial vehicles, or two-wheelers. And we believe that this year could again see a decent recovery on commercial vehicle and passenger vehicles. And many of these auto ancillary names should do well. So these are our preference for sectors. And on an overvalued basis, we believe that you have to go more on a stock specific rather than sector specific basis.
Pankaj, hi, morning. What's your outlook on the earnings season as we officially kickstart the earnings report cards today? In particular, if you could highlight for IT, but in general, where is it that you're seeing hits and misses?
So clearly, before we talk about the first quarter, let's reflect back on what happened last year. So last year, corporate India on an NSE 500 basis delivered about 10% earnings growth. And for the first time, we crossed 11 lakh crore absolute profit mark. But interesting, when you dissect that number, interesting analysis comes into fore is that the 78 BFSI company actually led the show, and they had actually 50% earnings growth. Whereas the 422 non-BFSI companies actually had degrowth because margins were under pressure. What we believe this year would happen is that BFSI's growth would taper down, but it still will be a decent growth to talk about. And on the other side, the non-BFSI space will see margin expansion. So this year it will be lower top line growth because WPI is already moved into negative territory. So you won't get the advantage of inflation with you as a producer. But on the other side, commodities have cooled off meaningfully and they would aid to margins. So we believe that non-BFSI space should start seeing earnings growth this year. And in the first quarter, we believe consumer space is badly impacted. India had the lowest wedding dates this summer compared to the last 5 years. Only 23 wedding auspicious dates were there. And that will weigh on consumption. And across our channel checks suggest that the consumer discretionary space is seeing slowdown, except jewelry, except hotels, except airlines. Most of the other consumer discretionary categories is seeing slowdown. So consumption names would see probably not so great results, and probably there could be a probability of a downgrade there. On the other side, B2B businesses led by infrastructure, capital goods, cement, all will continue to show robust numbers led by strong order inflow and strong execution. On the other side, BFSI space will continue to show decent numbers, but we will see reflection of margin contraction in the banking and financial services in this quarter. So our sense is for the whole of FY24, we should pencil down about 12 to 13% earnings growth, which will be slightly better than last year. And it will be mainly, largely by BFSI, but this time non-BFSI companies, 422 out of 500 universe, should also start contributing to the overall profitability.
All right. And given that you were talking about being stock and sector specific, would you like to share with us any particular sectors and, take us through where your preference lies? A quick word.
Yeah, so I said that incremental capital is getting allocated first in places where we have a chance of losing less money. See, in times like this, it's very easy to get carried by momentum. And I've always, as a house, we have always believed that during times of prosperity is the time where you need to be extra careful because mistakes are made at times like these. So we are asking ourselves every time when we deploy incremental capital, what is the probability of losing money here, and is there a margin of safety? So our sense is that look out for stocks which have margin of safety, where valuations are in your favor, businesses are solid over a medium to long term, and management, you are not compromising on the management teams which have a depth of seeing multiple cycles over a period of time. And that's how our bottom up approach is moving.
Right.
And we believe that incrementally, pharma, banking and financial
Okay.
services, IT to a certain extent, and maybe auto and auto hands are the sector where we are positive.
Thanks so much for joining in and giving us your take on the markets. All right, let's